Welcome to Invact, your ultimate destination for demystifying the world of investments. Gold can quickly rise above $2,400 per ounce in a short period of time, which we prefer to think of as an interesting coincidence. The macro narrative has always been a slow variable, and it is impossible to explain that the price of gold continued to rise above the important levels of $2,200, $2,300, and $2,400 per ounce in just 2 weeks. $2,500 was chosen as an important threshold because after breaking through $1,000 per ounce in 2009, gold experienced significant resistance when rising to the 20% to 25% range and then reached a new high after more than half a year of adjustment. We believe that this rapid rise in gold is the result of central banks around the world beginning to shift to easing. The Federal Reserve's March interest rate meeting tends to cut interest rates 3 times this year. Retail investors and Asian investors are quickly entering the market. However, we are skeptical about the assertion that the central bank's purchase of gold led to an increase. Its real effect is to keep the price of gold unchanged. Our view on bullish gold prices has not changed, but in the short term, the gold price will rise to $2,500 per ounce. The key word is inflation. Of course, an unexpected recession can also have short-term effects. Analyzing gold requires a clear understanding of medium to long-term logic and short-term logic. Currently, the 2 most important medium to long-term logical macro narratives are probably stories of changes in the macro environment of anti-globalization and high inflation after the pandemic, and the challenges to the credit and monetary system. The consequences are that the price of gold is asymmetrical decoupling from U.S. debt and the U.S. dollar. U.S. bond yields rise, the dollar appreciates, and gold stagnates. And gold may be more sensitive to inflation and commodities. U.S. Treasury yields are rising. Why isn't gold falling? We can analyze it from 2 levels. One is from the cost and return dimensions of the asset itself. The analysis represented by U.S. bond yields focuses more on holding costs, which may only dominate in a specific period and environment. What we usually call the price of gold is negatively correlated with the actual yield of U.S. bonds, mainly from the perspective of holding costs. The higher the actual yield on U.S. bonds, the higher the opportunity cost of holding gold. There was no problem in the decade after the 2008 financial crisis. In an environment of low inflation, low interest rates, smooth operation of globalization, and relative geopolitics, holding costs became the main contradiction of gold. However, from a more complete perspective, holding gold also has benefits, or summed up as a safety premium. Frequent risks, such as default, high inflation, and geopolitics will increase gold content, and safe assets that are not interfered with by sovereignty are more sought after by capital. After the pandemic, geopolitics and anti-globalization have been the subject of long-term headlines. Major overseas economies are facing the shadow of high inflation, and the governments of major overseas economies are still not going to back up even though their debt burdens have risen sharply. The frequency of credit risk incidents has increased, from debt restructuring in emerging market countries to major financial institution defaults. All of this has made investors pay more and more attention to safety premiums on the income side when evaluating gold prices. Thank you for watching. If you found value in this video, don't forget to hit the like button, subscribe to our channel, and share it with your friends and family. Together, let's embark on a journey towards financial enlightenment.